analysis of EURUSD on the 26th of June 2025. Okay, so again we start off with marking out the month's open just for reference, and the April high just for reference. Go to the week chart, mark out the week's open, fix this line. Okay, we'll mark out this liquidity sweep. Okay. Okay. So, as you can see, it's almost end of the week, and it does not seem like it's going to be a bearish week. So our bearish weekly bias probably is wrong. That's okay. As I said, when highs are swept, price generally will reverse to the downside, if only temporarily, and we managed to capitalize on just that temporary move, so it's okay. It's fine to be wrong in that way. So prices are lining up with this weekly gap over here. So I'm just going to keep that in mind. Price might react to that. Yeah, I mean, price is now swept this high, so it could still show reversal. But we're gonna kind of put our weekly bias aside for now. Okay, I'm gonna go to the daily chart. Fix this line up. So, I would say our daily bias is bullish. Just because this was a pretty strong bullish close, closed above the previous candle's high. So there's no reason to believe it wouldn't be bullish. And so far it looks like it might be. But that's just, again, just for reference, so just keep that in mind. Okay, let's see. We've got these gaps here. Just keep those in view. Okay. The 4 hour. Okay, so 4 hour, we've got a new market structure because price closed above this high over here. So we'll measure out this level from that low to that high, and we'll mark out the 4 hour equilibrium. And again, the equilibrium is just the midpoint of price leg, and if we're above it, we're premium. If we're below it, we're discount. You want to buy in discount, you want to sell in premium. Price generally wants to revert to the equilibrium point at some point. Okay, so what's interesting here is on the 4-hour chart, we can see that the bodies of these 4-hour candles did not close above the high of this weekly fair value gap. So that's an indication that price is respecting this weekly fair value gap. And since it's a bearish fair value gap, price wants to bounce down off of it. Since it is respecting it, that's an indication that yes, price does actually want to bounce down off of it. So that's giving me more of a feeling that maybe we do want to short. So let's mark out these 4-hour fair value gaps. Okay. We are going to measure. We're just going to measure this most recent leg, just to get an idea of where the midpoint is, just for reference. So if we are going to come down, we'll probably come down to like the equilibrium of this most recent leg. So that happens to line up quite cleanly with this 4-hour fair value gap. So that's a good target for us if we want to go short. Okay. Plus we swept this high, we could be looking to short today, potentially. I'm going to go to the 1-hour chart, just fix these up. Okay, so price did not respect the weekly fair value gap on the hourly chart, but that's okay. It's still interesting that it did on the 4-hour. So let's see. Okay, trading starts in 14 minutes. When there's large wicks, we like to just sort of also look at where the midpoint is. Price sometimes likes to react to that, so just keep that in mind as well. Okay, I'm not quite sure what we could do here. Short is possible. I'm going to go to the 4-hour and I'm going to see if price has reacted to any 4-hour fair value gaps. From 2021, and it actually has reacted to a little one over here. It's so old though, so it's not entirely relevant. that is very, when things line up like this, it's interesting. Something to consider. So price did bounce down off of that, so that's quite interesting. So maybe on the lower time frame we have a short somewhere here. I'm just gonna take this off for now. This price did respect this 4-hour fair value gap from 2021. Go back to the hourly chart. I think for now this low is pretty good target if we're gonna go short. It's the closest sort of target we could go for. So that's a good target. I'm gonna go to the 15-minute. So basically our analysis is just about finding these reference points and finding what price can react to, finding where price could go, where price is gravitating towards, where it could go, where it could go there from, when it could go there, why it would go there, and all of that. So let's see. So over here, this is quite a bit of an extreme liquidity sweep, but price did sweep that high, reverse, close below this last series of up close candles, and then we get a market structure shift over here. So this kind of fits our entry model. Could look at an entry over here. Like this. With our stop loss around there. There's a potential trade right there. It's not the cleanest entry model. It's hard to explain why I think that, but I think it's because this series of up close candles is kind of smushed together. It's not very prominent, and price swept this high by so much. Generally want a pretty shallow sweep and reversal, because that shows like more of a rejection. Like price didn't want to go much higher and it wants to reverse. So there's that. So 15-minute chart here. Price seems to be reacting to this little gap quite nicely actually. Okay. So we can maybe look for a temporary long with the idea of like price might go up a little bit and then go short. So it's like a preemptive trade. Like we're going long because we need price to go a bit higher before we can go short. Those are sort of lower probability, but you can do it. I'm gonna go to the 5-minute chart. And in the 1 minute chart. Let's see. I like this displacement, which is fast, impulsive, momentous movement with big candles and gaps. And then this is kind of an entry model. We just don't really have a sweep. So here you would have entered there. Look at that. So start trading here at 2 a.m. New York time. Yeah, we don't really have a nice sweep, so it doesn't really fit the entry model, so I'm not going to consider that an entry model. It did sweep this low, but this low is a bit insignificant. Like if there was a low, like over here, that was swept and we went up like that, then I'd consider this a pretty good entry model. But we don't have that. And a long would also be interesting because we've come up above this purple area is the weekly fair value gap. We've come up above it, come back down, and we could bounce above it as like an inversion fair value gap. Okay, price is moving pretty quickly to the upside here. These are basically relative equal highs, which again is like a magnet. So maybe price comes up, sweeps those, hits this gap, and we go short. It's an option. The only thing is it's a very large, far target, so it requires us to be more correct, which is harder and lower probability. I think I'd rather wait for like a lower time frame entry model. So like maybe price comes up here and reacts to this 15-minute inversion fair value gap, and we get a 1 minute entry model. Then we can enter because we'll have a tighter stop and a closer target, so technically be higher probability, or just just an easier target. So see what happens there. We did just sweep this high, so we might get an entry model. In that case, we would need a close below here. Because we have a sweep, change in state of delivery, which is a close below the last series of up close candles. The open of the last series of up close candles, and then we need a market structure shift, which is a break of the most recent swing low, which is a low that has a higher low to the left of it and a higher low to the right of it. So it's like a triangle, sort of like little triangle. That's a swing high, that's a swing high, that's a swing low, swing high, swing high, swing low. It's just a high and low, yeah. So we'll see what happens at the London Open at 2, which is 8 o'clock here. We could enter straight away on there, but looking at this, we do have a downwards trend line here. So that indicates to me that we have low resistance liquidity above this high. So price may want to come up and sweep this high, potentially. But it is a 1 minute trend line, so it's less significant. Generally, things on higher time frames are more significant than things on lower time frames. So just, something on the 1 hour is more significant than something on the 5 minute, something on the daily is more significant than something on the 1 hour. Just because it's like longer term, it's bigger picture. Okay, we got 5 seconds here. Let's see what happens. Okay, it's pumping down quite aggressively. It's a bit suspicious that it did that before it swept this high. That might be like liquidity inducement, which is basically they pump price down. That makes retail traders think, okay, let's short. So they put their stop losses above here, like there, and they think, okay, price rejected this high, this level is resistance. But basically that just induces or engineers more liquidity above this area for price to then come and sweep it and liquidate positions, increase the volume in the market, so then price can then come down. Yeah, this entry model is not looking so good anymore because price swept this high again. Generally, we want the last series of up close candles that was involved in the actual sweep. So the last series of up close candles in this sweep was like here, and there's no swing low for price to have a market structure shift. I mean, technically this is a swing low because this low is not lower than it. So I mean, technically you could enter here. This is technically an entry model. So you could do that. I'm definitely not going to take that because of what I said about the liquidity inducement. This is just sort of built relative equal highs over here, more accurate, more relative equal highs, like as in these were relatively equal, but these are more relatively equal. They're more equal than these were. So that just becomes more of a magnet on price. So I would not be happy to consider that price won't sweep these relative equal highs, and having our stop above there is, obviously dangerous. So I would not take that. We can mark it out though. We'll just make it blue because it's like a trade we don't want to take here. So what I'd like to see is price come up, react to this 50-minute inversion fair value gap, and then give us an entry to go short. I think that would be good. Swept this along. That's a pretty clean 5-minute entry model, but again, we've got these relative equal highs here, so we don't want to put our stop above there. So yeah, that's the analysis. I'll make part 2 if an entry comes up, I think. So this is also a decent 5-minute entry model. So in this case you would enter here. But again, our stop has to be above these relative equal highs, which is a bit sketchy. I mean, it's a valid entry model, but context is more important than the entry model. The entry model is just something you use to execute, get in. So yeah, it might work. It might work. It's you know, if it works, we miss out. But I mean, yeah, it is what it is. Plus, we are at like the low end of this leg, so I'd much prefer to go short a bit higher than these highs. So we'll see what happens.